Hey everyone, this is Caleb Franzen with Cubic Analytics. It is Wednesday, June 29th, shortly after the market close. And I wanted to put together this video today because I felt like today's session was rather choppy, very swingy, very emotional. And so I kind of had a tweet earlier this morning that kind of laid out some of the path for risk assets today and the importance of today's action relative to the early morning dynamics that we were seeing in the bond market. And so I'd like to kind of have that be the focus of today's conversation, highlighting this traditional relationship between yields and asset prices, because I think, again, this is where a lot of my general investment thesis comes from and is certainly one of the most important and critical things that I check on a day-to-day basis. And so, in fact, one of the first things that I tend to do when the market opens, instead of looking at the S&P 500 or the price of Bitcoin or anything else, is I'm looking at what 5, 10, and 30-year Treasury yields are doing. And so early this morning, we saw a drastic decline in yields across the maturity spectrum. And typically when we see that, we would expect to see risk assets and asset prices in general rise. Why is that the case? Well, yields and asset prices have an inverse correlation. So as yields rise, asset prices tend to fall, all else being equal, and vice versa. And so on a day when yields were falling dramatically, it was extremely important for us to see a follow through in risk assets, because when we're seeing yields fall and risk assets fall simultaneously, that's generally a sign of risk off sentiment. And so really quickly, before we kind of dive into the nitty gritty on that, I'd like to just point out some of the general action that we saw in the market today. So 5-year Treasury yields were down 3.3%. 10-year Treasury yields down 3.5%, 30-year down 2.96%. Meanwhile, the Dow Jones was slightly positive at 0.26%, the S&P 500 down 0.07%, the NASDAQ up slightly 0.18%, and the Russell was down 1.12%, had a really poor performance today for small caps. And so I want to explain really quickly why this is such a unique signal that we're seeing from the market and is generally telling us that we're in a risk off and defensive environment. So really quickly, what I've done is I've put together this quick little example to highlight the influence of interest rates on the present value of an asset to show why they have an inverse correlation. So let's imagine a scenario where a salesman comes up to us and tells us that they'd pay us $1 million in 5 years and asks us how much we'd be willing to pay for that asset or that security that's going to pay us $1 million in 5 years. And so in traditional finance courses, you learn something called the present value formula, which I have written here. And the present value of any asset is equivalent to the future value that that asset is going to bring you, divided by 1 plus the interest rate raised to the power of time, right? Whatever that time window is for you to recoup or earn that future value. And so we can simplify that as PV equals FV divided by 1 plus I raised to the T. And so if we consider an example of a 10% interest rate, we have basically all the variables that we need aside from the interest rate right now in order to solve for present value. So let's imagine that we can go out into the market and generate a 10% yield or a 10% interest rate on our capital. So 10% becomes our interest rate and 5 years is our time period. So we're going to have 1 million divided by 1.1 raised to the fifth. And in this example, it shows us that an investor in a 10% interest rate environment will be willing to pay $620,921 today in order to receive $1 million in 5 years from now. Now, if we instead look at a 2% interest rate environment, that investor, now that present value of that asset has gone up considerably. Because an investor is only able to generate 2% interest, they're having to pay much more for an asset that pays them $1 million 5 years from now in terms of what they'd be willing to pay for it today. And so as we can see, in a 10% interest rate environment, the present value of that asset is significantly lower than the lower interest rate environment. So again, as yields fall from 10% to 2%, the asset price goes up almost 50% from 620,000 to 905,000. So this is how we can mathematically prove that yields and asset prices have an inverse relationship, all else being equal. Now you can play around and maybe mess around a little bit with the future value there and figure out what future value payment you would need to receive in order to have an equal present value. But I think the point of this is just simply to show that yields and asset prices, all else being equal, have an inverse relationship. So with that basic understanding now, that core understanding kind of in our back pockets, when we see such mixed reactions happening in the asset markets relative to a substantial decline in yields, it's rather worrisome because it essentially shows us that perhaps there's concerns around that future value portion of the asset. Whether that means dividends aren't going to be worth as much, whether that means the raw earnings or revenue growth of the businesses are being downgraded or are less optimistic in the eyes of investors, all of these things have considerable impact. So when we're seeing such a dislocation in the traditional relationship between yields and asset prices, in my opinion, that rings a lot of alarm bells that we're in a risk-off environment. So traditionally, we expect to see yields and the dollar have a direct relationship. As yields go up, an investor who holds the same dollar is going to be able to generate a higher return on that dollar because interest rates are rising. So yields and the dollar have a direct positive relationship. However, in a risk-off environment, we may see yields fall and the dollar still rise because investors are leaving traditional assets or securities and they're shifting purely into the dollar, a safe haven asset. And so if we look at the dollar today, it was up just above 0.5%. Specifically, it was up 0.57%. This is a classic breakout, retest, rebound setup that I've been highlighting and sharing on Twitter. If you've been following me there, you know I've been bullish on the US dollar since October, back when we were pretty much in this environment back here. I was posting that if we broke above this level, that could provide tailwinds for the dollar to rise. Sure enough, the Fed announced tapering in November, and the dollar hasn't looked back since, right? We've just continued to make higher lows and higher highs, which is indicative of a bull market, and we've actually broken above this multi-year resistance zone. And so as we've broken above that level, we've actually now turned it into support here on this recent retest, and we're starting to accelerate higher. If we close tomorrow above 104.66, that's going to be the highest weekly close in a very, very long time, basically since 2002, so in 20 years. So this is a very key moment right now for the US dollar in this market as it continues to kind of chug along higher, and again is indicative of a generally rising rate environment. But even when rates aren't rising, we're seeing investors remain defensive and have bids for the US dollar. And so I think I'll probably cap the video off there. I would like to just briefly mention one thing with Bitcoin specifically, which is that Bitcoin today has been able to at least take back some ground in terms of the early morning levels where we started today's session. If we basically look at the 9 o'clock hour, the 9 o'clock open, we had a big spike here in the last 2 hours, but now Bitcoin's starting to reverse again. But Bitcoin from basically today's open is up 0.8%, which is an encouraging sign, particularly when yields are falling. But this lack of conviction here on this hourly candle is not very convincing. It's not very enthusiastic, in my opinion. And so one of the things that I actually posted about on Twitter earlier today was that if we look at the long-term chart of Bitcoin futures when they first started trading back in December of 2017, we can see here that this open for Bitcoin futures is a very key level. Not only was it resistance, basically finalizing the highs of that prior cycle, but it acted as kind of the line in the sand for the breakout. And now we've been hovering around it here over the course of the last 2 weeks or so as Bitcoin continues to kind of struggle around this $20,000 to $19,000 range. So I posted earlier this morning that the longer we stay in this range, the worse it is for short-term Bitcoin price action, because as as price continues to stay here, investors are going to become less enthusiastic. They may capitulate more easily at these levels if we're not seeing any movement, with the intention of maybe buying back in at a lower price, or just saying, you know what, screw it, I need a break from all this mayhem, I got to get out now. People's cost basis is definitely going to help to influence those decisions, but in my opinion, this isn't a very enthusiastic look for the price of Bitcoin right now. Be sure to check me out on Twitter. I've showed some pretty interesting long-term analysis for the price of Bitcoin using weekly and monthly candles, looking at Williams %R indicators, long-term moving averages, the relationships between different moving averages, and how we can essentially rely on those signals to plan for our dollar cost average schedule, or at least mentally prepare for price action in general, and essentially try to glean some clues from Bitcoin's historical price action. So I'm gonna leave the video here. Again, I really just wanted to specifically focus on the relationship between yields and asset prices and point out how today's market dynamics were very indicative of a risk-off and defensive market where yields and asset prices generally both moved to the downside, while the dollar and I think bonds were up today. Let's see. Yeah, bonds were clearly up today. Again, this just kind of cements the idea that we're in a risk-off market over this last week for certain. And so, yeah, I'll cap it there. Be sure to follow me on Twitter, like I said. If you want to sign up for my free newsletter, I'll be publishing that on Saturday, basically discussing the key data and market dynamics that I'm seeing in the broader macroeconomic system, in the stock market, and in Bitcoin specifically. So be sure to check that out, cubicanalytics.substack.com. I'll have all my links down in the description, and we'll talk soon. Take care, everyone.